What is an LBO model? An LBO model is a financial tool used by investors to evaluate the purchase of a company using a large amount of debt. The goal of LBO is to use the borrow money to buy a company and run it efficiently and then sell it at a profit. LBO model template key inputs. The key input section of these models includes all the essential assumptions and data needed to run the model and assess the potential return of the transaction. Assumption. Here's a breakdown of what the LBO model's template key inputs typically includes. There are three assumptions. First assumption is acquisition cost. Second is financing structure. Third is operational assumptions. So first, acquisition cost. So there are three parts of acquisition cost. First, purchase price. So purchase price is a total cost to buy the company. It often includes the price of all shares plus existing debt. Second part is acquisition cost. It usually based on the entry multiple times LTM EBITDA or the last 12 months EBITDA, then you add the company existing debt if applicable. This helps determine the purchase price. The last part of operational cost is the exit assumption. So, exit assumption is what the company might be worth when sold based on the exit multiple and the expected EBITDA in the exit year. Second assumption is financing structure. So, this assumption determines how much of the purchase will be funded with debt versus equity. It includes type of debt used, interest rate, and fees related to arranging the debt. And the last assumption is the operational assumptions. These assumptions estimate how fast the company will grow, how profitable it will be, and how much cash is needed to run.
So next is there are two, which is the source and uses of fund. So source is the identified debt and equity components used to finance transactions. So it means it shows where the money came from. So usually from loan, bank, or mga equity na. So ang uses is allocate funds to purchase price, refinancing the existing debt. So transaction fees and any capital expenditure, so which shows how the money is spent in the transactions. So usually mga transaction fees and financing fees and so on.
So there are three types of financial projections. The first one is the income statement or profit and loss statement. So it shows a company's financial performance over a specific period. Example, like a quarter or a year. It summarizes revenues or money earned and expenses or money spent to determine the net income or profit or net loss. So it has 4 key components. The first one is the revenue or the total amount of money generated from sales or services. The second one is the expenses or the cost incurred in running the business, including cost of goods sold, operating expenses like rent, salaries, utilities, and interest expense and taxes. The third one is the EBITDA or the earnings before interest, taxes, depreciation, and amortization. So it's a measure of profitability that excludes these non-cash expenses, giving a clear picture of operating performance. The last one is the net income or the bottom line. It's the profit remaining after all expenses are deducted from revenue. This is a key indicator of a company's overall financial health. So the income statement projection would forecast these figures for the investment period, showing how revenue and expenses are expected to change over time. This is vital for investors to assess the potential return on their investment. So the second financial projection is the balance sheet. It provides a snapshot of a company's financial position at a specific point in time. It shows what a company owns or its assets, what it owes or liabilities, and the owner's equity or the difference between assets and liabilities. So it has 3 key components. The first one is the assets, or what the company owns, including cash, accounts receivable, or the money owed to the company, inventory, property, plant and equipment, or PP&E. The second one is the liabilities, or what the company owes, including accounts payable or money owed to suppliers, loans, and other debts. The last one is the equity, or the owner's stake in the company. This is calculated as assets minus liabilities. So the balance sheet projection would show how the company's assets, liabilities, and equity are expected to change throughout the investment period. This is particularly important because it shows how the new capital structure, or how the company is financed, will affect its financial health.
Next is cash flow statement. Focus on free cash flow as this will be used to pay down debt over time. So, free cash flow, or FCF, is the cash the company generates after covering operating expenses and capital investments. So, the cash available for debt repayment, dividends, acquisitions, or reinvestment is showing positive. FCF indicates a company's ability to manage its debt effectively and improve its financial health over time, reducing risk for investor and creditors.
So the debt schedule is repayment plan. So repayment plan is the timeline of paying down the various tranche of debt utilizing excess cash flow generated by the business. So repayment plan is an argument between sa borrower o lender outlining so how much the borrower will pay each month and over how many months or years the loan will be paid. So second is interest expense. So interest expense is calculate the interest cost associated with each debt tranche and its impact on net income. So interest rates is the cost of borrower incurs for using borrower funds. So nagrepresenting sa amount sa interest on their debt. So it's non-operating expense. So meaning it's dili siya directly related sa company or business activity. So essentially it's the price of borrowing money, like paid to a lender for the privilege of using their money.
In a leverage payout LBO model, we focus on the outputs to understand if the deal is good for investors. First, we look at the IRR, international rate of return. This tells how much return investor can expect from their quality based on the future cash flow and the sale value at the end. So the next one is we check the debt metrics like debt ratio and interest coverage ratio. They show how much debt company has compared to earning and if it can pay interest rate help us measure the financial risk. And lastly we look at the quality returns, especially the multiple of quality. They show how many times the investor money can grow, and we compare this to target return to see if the deal is worth it.
To use an LBO model templates, we follow case steps. First, we set up the model by entering all important assumptions like the purchase price, how much will be paid with debt and equity, and expected business performance. Next, we build a financial statement including the income statement, balance sheet, and cash flow statement. The health forecast how the company will perform after the buyout.
In a leverage buyout LBO model, a company is bought using both equity and a lot of debt. We analyze the output by checking key members like IRR, equity multiple, and debt ratio to see if the deal is profitable and safe. We also do a sensitivity analysis by changing key assumption. key assumption like purchase price, exit price, or EBITDA growth to see how they affect returns. If the dual still look good, it's a strong investment.
So the first step in model assumption, so as you can see from the table, there are entry valuations in the two assumptions, which is the transaction assumption and the debt assumption. So in entry valuation, the first step of the LBO modeling test is to determine the entry valuation of two corporations on the date of the initial purchase. So to get the purchase enterprise, the volume multiple, the LTM EBITDA stand for last 12 months earning before interest, taxes, depreciations, and amortization. So, i-multiply rin naman ito sa entry multiple. So now, where we get the LTM, EBITDA, and the entry multiple ba? So, given na ni siya from the given problem.
Here's the debt assumption. Debt assumption with the entry evaluation and transaction assumption filled out. We can now list out the debt assumption related to its debt tranche is such as a terms of EBITDA. Ex-EBITDA is a pricing terms and amortization requirements. And the amount of debt that the lenders has provided is expressed as a multiple of EBITDA, also called a turn. For instance, we can see that 400M was priced in the terms loan B as the amount was 4.0x EBITDA. And the total is the initial leverage multiple used in this transaction was 6.0x since 4.0x was raised from TLB and 2.0x in senior notes. For example, in the LIBOR was at 1.5% and the floor was 2.0%, the interest rate on these terms loan B would be 2.0% plus 4.0% equals 6.06%. But if the LIBOR was 2.5% and the interest rate on the TLB would be 2.5% plus 4% equals 6.5%. As you can see, the interest rate cannot fall below 6% because of the floor. In the final column, we can calculate the financing fee based on the amount of debt raised. Since 400M was the rise in term loan B and 200M was the rise in senior notes, we can multiply each by the 2% financing fee assumption and the sum of up to arrive at 12M in the financing fees. Here the formula used step is purchase enterprise value equals LTM EBITDA times entry multiple, and debt amount is equals debt EBITDA turn x LNB EBITDA, and financing fee equals debt amount times present fee.
The transaction fees for June included 10M for advisory work and 2% debt for financing fee for raising debt capital. So the minimum cash balance required post-closing was 5M, indicating June Co needs 5M in cash on hand to meet the short-term working capital obligations. So debt assumption related to each debt tranche included terms of EBITDA, pricing terms, and amortization requirements. The initial leverage multiple used in the transaction was 6.0 times with 4.0 times raised from TLB and 2.0 times in senior notes.
So in the next step, which is the 2, this is the sources and uses table. So this step is we will build out the sources and uses schedule. So it's layouts how much it will cost in total to acquire two corporations and where the required funding will came from. So for this step 2, actually simple na siya. Makita na siya sa tanan sa step 1, as you can see. And to get the formula of sponsor and equity and the total sources, kanina siya ang gamitan na formula.
Here are the steps on how to solve the free cash flow. Step 1. The project revenue. Start with the current revenue and apply a growth rate each year. Example, 1,000 million times 1.10 is equal to 1,100 million. Next is calculate the EBITDA. EBITDA equals revenue times EBITDA margin 10%. Step 3 is calculate EBIT. The EBIT equals EBITDA minus depreciation, 2% of revenue. Step 4 is calculate EBT equals EBIT, interest and financing fees. Step 5 is calculate the net income. The net income equals EBT minus taxes, 35%. 6 is calculate the free cash flow. The FCF, net income plus depreciation plus financing fee amortization minus capex, 2% of revenue, minus change in working capital, 1% of revenue, minus debt repayment. 7 is update cash balance, ending cash and beginning cash plus FCF. So this free cash flow projection shows a company with strong and consistent financial growth. Revenue and profit increase steadily while cash flow improves year by year. By 2025, the company builds a healthy cash balance of 65 million, indicating solid financing health, efficient operations, and the ability to invest, repay debt, or return value to shareholders.
Step 4, debt schedule, is all about tracking the loans used to buy the company. This table outlines how the debt used to finance the acquisition is projected to behave over the 5-year holding period from 2021 estimate to 2025 estimate. So from the top section, first is LIBOR, or the London Interbank Offered Rate, or the LIBOR for each year. LIBOR is a benchmark interest rate that often serve as the base rate for floating rate debt like a revolver. You can see it's projected to increase from 1.5% from 2021 estimate to 2.3% in 2025 estimate. So first is the revolver size or the paydown. This row indicates the maximum borrowing capacity of the revolving credit facilities. In this case, it's consistently shown as negative, implying there's no planned borrowing or pay down of the revolver during this period. Next is ending balance. Since there is no borrowing or pay down, the ending balance of the revolver remains at zero across projected years. So next is the total revolver capacity. This reiterates the maximum amount that can be borrowed under the revolver, which is 50 million throughout the projection. Next is beginning available capacity. This shows how much the revolver's capacity is available at the start of each year. It remains at 50 million because no amount is being used. Next is revolver borrowings. So this confirms that there is no additional borrowing under the revolver in any of the projected years. And next is the revolver interest rate. This is the interest rate charged on any outstanding revolver balance. It's calculated as LIBOR plus a spread. In this case, LIBOR is 1.5% plus the spread is 4%, so it equals to 5.5%. You can see it increasing year over year. So next is revolver interest expense. This is the amount of interest expense projected to be incurred in the revolver. So since the ending balance is zero, then the interest expense is also zero for all years. Next is the unused commitment fee. This is the fee charged by the lenders on the unused portion of the revolver capacity. In this case, it's a small percentage of the unused amount from 50 million, resulting in a consistent fee of 0.1 million or the 100,000 per year. In the middle section, the term loan B. So the term loan B, this row represents the initial principal amount of the term loan B, which is the 400 million in 2021 estimate. Less mandatory amortization. Similar to the term loan B, this would show any scheduled principal repayments for the senior notes. In this table, it's 0, indicating no mandatory amortization. Next is ending balance. Consequently, the ending balance of the senior notes remains at 200 million throughout the projection. So, next would be the senior notes interest rate. This is the fixed interest rate on the senior notes at 8.5% per year. So the 8.5% is fixed rate. It means that there is an agreement from both the company and the lender that they decided that 8.5% would be the interest rate. So next is the senior notes interest expense. This is the annual interest expense for the senior notes calculated by multiplying the beginning balance by the fixed interest rate. So the beginning balance is 200 million times 8.5% is equals to 17 million. Since the balance and the interest rate are constant, the interest expense remains at 17 million on each year. So overall, in summary, this debt schedule illustrates how the different layers of debt used in LBO or leverage buyout are projected or evolve over the 5-year holding period. It shows the revolver is expected to remain undrawn. The term loan B will gradually pay down through mandatory amortization. The senior notes will remain outstanding with no scheduled principal repayments. The interest expense for the floating rate debt, the revolver and term loan B will fluctuate based on the projected LIBOR, while the interest expense for the fixed rate senior notes will remain constant. This information is crucial for understanding the cash flow obligation of company and how the debt structure will impact its financial performance over the projected period, which will ultimately feed into the exit valuation.
Step 5, returns calculation. Now that we have projected the financials and the net debt balance for the 5 years holding period, we have the necessary inputs to calculate the implied exit value for each year. The first input will be the exit multiple assumption, which was stated as being the same as the entry multiple, 10x. And the next step, so as you can see in the next line, you will see the item for exit EBITDA, so which simply links to the EBITDA of the given year. We will grab this figure from the FCF forecast. To get the exit enterprise value, you just simply multiply exit LTM EBITDA to exit multiple assumption. So in the year 2021, $110 times 10 multiple. So the answer is $1,100. So that is the year 2021 exit enterprise value. Just same in the 2022. Just simply multiply the exit LTM EBITDA in the exit multiple assumption. So 121 times 10 multiple is equals to 1,210. In the year 2023, $133 times 10 is equals to $1,331. In the 2024, $146 times 10 is equals to $1,464. And the 2025 is 161 times 10 is equals to 1,611. So now we will get the exit equity value. So to get that, similar to how we did in the first step for the entry valuation, we will then deduct the net debt from the enterprise value to arrive at the exit equity value. The total debt amount is the sum of all of the ending balances and the debt schedules, while the cash balance will be pulled from the cash roll forward in the FCF forecast. So as you can see, in the DEF 2021 is 580. So 580, we will get that in the DEF schedule, which is revolver ending balance is 0, and then the term loan B, the ending balances is 380, and in the senior notes, the ending balances is 200. So let's just add that to get 580. So same as in the 2022, just simply add the all ending balances. So 360 plus 200 is equals to 560. And 2023, 340 plus 200 is equals to 540. And in the 2024, 320 plus 220 is equals to 520. And in 2025, 300 plus 200 is equals to 500. That's how we get the DEF. In the cash, we will get that through step 3, free cash flow projection. So the ending cash balances in 2021 is $5 million. In 2022, $11 million. 2023, we have $23 million. In 2024, we have $41 million. In 2025, we have $65 million. We will get the exit equity value. So 1,100 minus 580 plus 5 is equals to $525. In the year of 2022, 1,210 minus 560 plus 11 is equals to $661. In the year of 2023, 1,331 minus 540 plus 23 is equals to 814. And the year 2024, 1,464 minus 520 plus 441 is equals to $985. In the year 2025, 1,611 minus 500 plus 65 is equals to 1,176. So that's all the exit equity value. To calculate the exit equity value, just simply subtract the DEF in the exit enterprise value and add the cash. So in the year 2021, 1,100 minus 580 plus 5 is equals to $525. In the year 2022, 1,210 minus 560 plus 11 is equals to $661. In the year 2023, 1,331 minus 540 plus 23 is equals to $814. In the year 2024, 1,460 minus 520 plus 41 is equals to $985. In the year 2025, 1,611 minus 500 plus 65 is equals to 1,176. So that's all the exit equity value. So in the final step, we will calculate the two returns metrics we were instructed by the prompt. So starting with the internal rate of return, IRR, to determine the IRR of these investments, you first need to gather the magnitude of the cash outflows and inflows and the coinciding dates of each. So the initial equity contribution by the financial sponsor needs to be inputted as a negative, since the investments is an outflow of cash. In contrast, all cash inflows are inputted as positive, but in this case, the only inflow will be the proceeds received from the exit of Company X.